Gene Munster from Loup Ventures talking about the Apple March quarter. Shares up about 3% in the aftermarket because investors were bracing for a guide down, and that in fact did not happen. The iPhone business was essentially stable. There are three key takeaways, and these mark what I think is going to be a shift in terms of how investors think about the Apple story over the next several years. First is the iPhone business is getting more stable. It grew 3% in the December quarter. It's modeled to grow up 2% in the June quarter, and it was down 1% in the December 17 quarter. So if you look over the past 3 quarters, it's essentially flat. That should start to ease some investor anxiety about what this is quarter to quarter. That's the good news. Bad news is that the iPhone is probably not going to be a big growth business, probably 0 to 5%. Second, services up 31% versus the street expectations of 18%. Services accounted for 15% of total sales, and this is a very predictable part of their story as well. You combine that 15% with the iPhone at 60%, you get to about 75% of Apple's business is more predictable, which should be good for Apple's multiple. And the last important piece is the capital return. They announced a $100 billion capital return, did not give a timeline this time, but that was essentially in line with investor expectations. More importantly, though, that lays the groundwork for future increases. We think it'll take about 2 to 2.5 years to return that $100 billion. As investors get more confident about the sustainability of that capital return, that should be also a positive for the story. So when you put all this together, it's just more visibility in the Apple story, which should be good for the overall multiple. One last quick piece is we do expect some new iPhones in the fall, likely a even higher priced, bigger phone, but I'm sure the rumor mill will run that over the next few months. For Loup Ventures, this is Gene Munster.